My guest today is Paul Graves. He's the Chief Executive of Arcadium Lithium, which was formed in January from the all-stock merger of Livent and Allkem. Before that, Paul Graves was Chief Executive of Livent since 2018. He has long experience in the lithium sector and was formerly an investment banker for Goldman Sachs. Paul, thank you so much for joining me. You've talked about the merger with Allkem as being a transformational deal for the sector. Could you remind us about the strategic rationale for the deal and how hard has it been actually completing the deal, getting to completion in January?
Look, whether it's transformational for the sector, time will tell. We certainly think it's transformational for both Allkem and for Livent. It's clear to us that, and you can see it today in the market more clearly than ever, that the lithium industry is at the heart of a rapidly evolving and rapidly changing situation and environment, whether that's the pace of change, the battery technologies that the automotive companies are chasing, the capabilities of various people to produce lithium of different types and of different grades. One thing that's clear to us is that if we as an industry are going to keep up, we need to have a wider range of capabilities. That includes a wider range of resources to draw upon. Being a single resource operator, which is essentially, to all intents and purposes, what both Livent and Allkem were, is not going to be a winning model. I think being focused on only one form of lithium, whether that's carbonate or hydroxide or metal, is also in the long run not going to be a winning model. If we want to have close relationships with our customers, ones that work to the benefits of both us and our customers, we know we need to be larger, more diverse. And we think the merger brings that. It brings some operational benefits for us. As I'm sure you know, we are relatively close in some areas, especially in Argentina at Hombre Muerto and also in Quebec. But we also have complementary technologies, whether that's hydroxide capabilities coming from Livent and hard rock mining capabilities coming from Allkem. And of course, there are synergies of putting the two organizations together, removing overlapping costs, driving our costs down across the organization, sharing technical capabilities as well. So the benefits to both Allkem and Livent are just really, really abundantly clear. In terms of putting two organizations together, it's not an overnight process. Clearly, it's in some regards more difficult, but in some regards easier to do it in the environment that we are in. I think it forces us to look very carefully and very hard at exactly what our primary focus is. We don't have the cash flow to do everything. And so we have to bring some discipline to both of our organizations. So we're 3-4 months into that process. We never expected it to be done overnight. We're very pleased so far with the fit between the two organizations, a very good cultural fit. Like I said, very complementary capabilities between the two organizations. We've identified quite a significant number of synergies that we've been looking for, so we feel pleased about that. We've been able, while it's difficult to do, we've taken the difficult decision to do some rationalization of headcount. So we have been able to very quickly move to the new operating model for the new business, which has given us the opportunity to reduce headcount and therefore reduce costs as well. And we feel we're today at least in a very good position to move forward. This is a growth company. We have to grow. We have to keep expanding. So far, we feel pretty good about the progress of the merger towards that objective.
And in terms of supplying the automotive market, is it the case that there was customer overlap, or did Allkem bring automotive customers to the deal already?
Very different philosophies and strategies, which really revolves around a very different product suite. I think it's fair to say that Allkem was much earlier in its journey towards becoming a customer-focused organization. They absolutely saw the value in that. And so we talk about cultural alignment, very similar approach. Allkem have a very close and important relationship with Toyota Tsusho, which itself represents Toyota Motor Company and PPES in Japan, as well as other customers. So certainly complementary, no overlap at all in terms of customers, almost no overlap in terms of product, to be perfectly honest, with Livent really being a hydroxide, a butyllithium, and a metal organization with very little lithium carbonate, whereas Allkem is predominantly a spodumene concentrate and especially a lithium carbonate organization. So the commercial fit was actually pretty good, certainly no competing customers, put it that way.
And in terms of the different product mix, as you say, they brought more lithium carbonate. How long does it take to either, put that to battery grade product or qualify that material with the automotive sector? What's the sort of delay we're looking at?
It's not quite as simple as that. I think, as I'm sure you know, lithium carbonate applications are wider and broader and more diverse than lithium hydroxide. The process of capturing maximum value from the portfolio includes, frankly, producing as much carbonate as possible. Given the nature of brine production, that largely means technical grade, not battery grade. For most processes, certainly most conventional processes, producing battery grade derates your production. So the aim is to use as much of that technical grade product in the hydroxide network that Livent brings, which frees up Livent's lithium carbonate, which is, just because it's a very different process, pretty much straight away battery grade. It frees up greater capabilities to sell that battery grade product. Today, at least, the lithium carbonate coming out of the former Livent operations is either qualified already or being qualified today. And we're in the process now of migrating technical grade lithium carbonate from Olaroz, for the Allkem portfolio, into our lithium hydroxide network. That does require requalification of the hydroxide. That will typically take anywhere between 3 and 9 months, depends on the customer, depends on the application. So we're certainly heading down the path of very early stages, but at the early stages of optimizing the network in that way.
And how do you see this split going forward? What are you seeing from automotive roadmaps in terms of, we've seen the incredible rise of LFP in China. Is that going to continue in the West? We're seeing LMFP, sort of higher energy density LFP. How do you see the split emerging as EVs develop in the West?
It's a really difficult one to answer. I think from our perspective, we feel pretty good whichever way it goes, given the way that we convert carbonate to hydroxide. We can be there either with carbonate for an LFP or an LMFP application, or of course, we're one of the few companies in the world that have proven that we can produce lithium hydroxide. I think the answer to where it goes, I don't think even the OEMs bluntly today can answer that question for you. I do think that there was a swing too far towards lithium hydroxide in many OEMs' plans, and we recognize that. And you'll notice that we've been building out carbonate and moving to a long carbonate position, or trying to, for the last few years now, because we recognize that the lithium hydroxide contribution was unlikely to be larger than the lithium carbonate contribution. We've never expected hydroxide to be larger than lithium carbonate. And I think the OEMs, depends on the market, depends on their vehicle roadmap, depends on the maturity of their product portfolio. It's clear that the initial vehicles that have been launched by many OEMs are hydroxide based because they're higher value premium vehicles where range is so important. As you move to more mass market applications in what I'll call more conventional environments, like large parts of Europe and parts of Asia, then there's more of an LFP or even a mid-nickel. I mean, I wouldn't get too hung up on LFP itself, but I think there'll also be a move to NMC, mid-nickel NMC chemistries or related chemistries as well. So all of this suggests to us that the predominant chemistry will be carbonate based, but there's going to continue to be a significant lithium hydroxide requirement. I mean, if we look at 2025, 2026 lithium hydroxide requirements today, they're still higher than they were if we'd asked the same question 2 years ago. So I think sometimes it's such a fluid market, it's easy to get caught up in the short-term swings, but the trends for both carbonate and hydroxide-based technologies are still pretty strong.
So do you think it could be an evenly split market globally then?
No, I think it'll be more carbonate than hydroxide. I do. I think it'll be over time. I think when you look at it in the future, I think carbonate's easier to work with. It's easier to handle. It's not necessarily easier to make and not easy. It's actually quite difficult to make battery grade carbonate from brine, particularly if you don't design the process right on day one. So I do think that we'll see more and more lithium producers moving towards carbonate and less of an excessive focus on hydroxide because, frankly, I think they realize how difficult hydroxide is to make. But I would expect, I don't know the exact mix, but I'd certainly expect carbonate to be larger, meaningfully larger than hydroxide in the long run.
Got it. And in terms of direct lithium extraction, Livent obviously pioneered that in Argentina. You've also invested recently in Ilad Technologies and their DLE technology. Can you tell us a bit about how that could potentially improve yields in Argentina and increase production?
Yeah, look, the DLE process we use today, it's not that different to the Ilad technology. I mean, the easiest way to describe it is Ilad is sort of a Livent technology 2.0. And we like it because it brings, it's not that it's a better DLE process, but it does have some advantages in terms of lower energy usage, lower water usage. It's not a yield issue, not compared to our existing DLE process. Our yields today are in 80-90% of the lithium in the brine we capture. Now you compare that with a conventional pond process, where by the time you get to the very end, depending on how you manage it, you could be as low as 30% yields. I think there's a bit of an excessive focus sometimes on the lithium yield piece of it. I think if we were in a different environment where maybe the lithium in the brine was scarce or was subject to quotas, which it is not in Argentina, it may be a bigger issue. But there is a sustainability benefit to pumping less brine and extracting more of the lithium. The bigger benefit, to be perfectly honest, is it tackles really the fundamental challenge of conventional-based processes, which is how do you remove the impurities. The reason that you tend to see most conventional processes, certainly in Argentina, producing technical grade carbonate is because the removal of the impurities is actually quite difficult to do. And the DLE process absolutely, I wouldn't say solves that problem, but it moves you a massive way down the path. It simplifies the post-DLE process too. The carbonate process is much simpler if you use a DLE a technology that works. Look, from our perspective, it's really about the sustainability piece. It's about rolling out Ilad's technology to take advantage of its lower energy and its lower freshwater usage. These are key constraints. I think what you'll find, I try and say this to everybody when they ask me what's the best way to extract lithium from brine, and I ask them two questions: what is the brine, and how much above ground infrastructure do you have? DLE requires more above ground infrastructure. It won't fit everywhere, but we think it's going to fit pretty well in future expansions in Hombre Muerto, whether that's at Sal de Vida or at Phoenix, the old Livent operation. And we're taking a long, hard look about what we can do for future expansions at Olaroz, or even retrofitting existing operations using DLE technologies.
Interesting. So you raised sustainability. I wonder what you're seeing from automakers. Is there any indication that we could move towards paying a premium for more sustainable lithium? What are you seeing from their side?
I think they will favor more sustainable lithium. Will it drive a premium? Look, I think there's a bunch of factors at work. Not all lithium now increasingly can be treated the same way. I mean, anything that is IRA qualified clearly is more favored for many many producers, to be honest. Anything that does not come through an FEOC is also increasingly favored by US producers, particularly. And certainly there's a focus of sustainability by many customers, not all, but by many customers. I think it'll evolve. I think it will evolve that we will have different, if you will, flavors of lithium depending on which boxes they check. I'd be very surprised if there's a sustainability or any other kind of premium for lithium that ends up in a Chinese vehicle. I think it's much more likely that the European market will be amenable to it. And I think the US will sit somewhere in the middle, to be perfectly honest. I think the bigger challenge, bluntly, with the premium is less about sustainability itself driving a premium. It's the fact that to really produce lithium outside China, bluntly, it takes a lot more capital. And I think it's going to have to, the pricing has to reflect that. It just has to. It does today, bluntly. I think when people look at indices and they look at the China index, but as you've maybe heard me say for many years now, Henry, that index does not really reflect particularly accurately the market price that we all recognize and see in the customer prices. And I think over time, we're going to have to find ways to price the product that gives an appropriate return to both the capital we put to work and the risk that we take in putting that capital to work. Frankly, otherwise, everybody's just going to produce technical grade carbonate, and that's not what the market needs.
And can you give us a sense of the cost difference between, you've built a lithium processing plant in China, I think it took 8 months, took 2 years for the expansion in North Carolina. What is the rough cost difference between China and the US? Yeah,
the time difference is a little unfair there because the North Carolina plant did get caught up in some COVID delays. So the time is less the point. It's probably, a year versus a year and a half. So China can do it inside a year. In the US, we can do it in a year and a half, particularly if we are able to do what are times and construction times. But the cost is meaningfully different. You mentioned China. We built a 15,000 ton plant in China. it cost us just over $20 million in 8 months, as you said. And I think an equivalent plant today, our best estimate to build that in the US would be closer to $200 million. So it's a really significant cost difference. It's meaningful.
So are automakers, given the incentives in the IRA, as you mentioned, the FEOC, Foreign Entity of Concern, I think that prohibits lithium being processed within China. So are they willing to pay for that domestic or North American supply?
It's a bit more complicated today, Henry, because the issue is less about the lithium, to be perfectly frank. It's the cathode capability, right? It doesn't really matter if you get US lithium if you have to send it to China to be turned into appropriate cathodes. And that's the case with LFP, for example. I mean, it's all very well. Chilean carbonate is IRA qualified because there's a free trade agreement. Argentinian lithium carbonate is not. Doesn't really matter if that carbonate is going to go direct into a battery. Today, at least, pretty much has to go through a Chinese plant for LFP and even increasingly for mid-nickel. So today, it's a much more complicated question. I think in the long run, if the cathode industry, the cell industry, builds a network that network is IRA qualified, then the question of where the lithium comes from will become more relevant. But we're not there yet.
But in terms of, I think you said before, there is demand for IRA qualified material. Yeah, I guess where you sit now, you have double the capacity in China that you have in North America. Why are you not accelerating, your plans in Quebec? Why are you actually sort of slightly delaying the spending?
We're certainly not delaying our plans to produce lithium hydroxide. I mean, the reality is that in Nemaska, we have a plant in Bécancour we're building. It's a 32,000-ton hydroxide plant. We're doing it as quick as we can. So it's not China speed, but we're doing it as quick as we can. And we feel pretty good about that plant progress as well, well underway. It'll be complete by late 25, early 2026, and certainly be expected to be producing for, significant IRA qualified material by the end of 2026. Building another plant is not easy. It's $1.2 billion to build that plant. Pricing today just doesn't justify it. There's no way we will build another plant if hydroxide is $14. It's just not going to happen. I think the other challenge that we have is we have a disconnect sometimes. Quebec is extremely keen to attract the battery supply chain, has provided significant support to cathode producers and cell producers, and is not supplying any support whatsoever to lithium production. And so it isn't entirely obvious that the slower pace of construction, the somewhat tougher sometimes permitting requirements that you get in Quebec justify construction there. So we paused to really look at what the options are to build downstream capability to be fed by the James Bay spodumene concentrate mine that we will build. We absolutely will still build up there in Quebec. Nemaska is an integrated operation, so the 32,000 ton is fed by a 100% owned mine called Whabouchi, so that remains on track. But in terms of building downstream capability, just like everybody, we have to constantly reassess: are the plans to build where we originally start the right place, or does the next phase warrant building somewhere else? We may build in the US, for example, and move spodumene down to the US from Quebec. We certainly have plenty of space at Bessemer City in North Carolina, and it's certainly the case today, at least, that there are potentially more incentives from the US government to do that than there are from the Canadian government, for example.
So that would be the tax credits in the IRA, right?
And direct funding as well. There are grants available, there are incentives available. And there's a bunch of different ways in which it economically may make more sense to build in the US than it does, even though you have to ship the spod concentrate further. Frankly, it's no further than from Western Australia to China today, so it certainly can be done economically.
But what about the sort of hydropower that Quebec offers, that sort of sustainable potential for lithium? How important is that?
It's important if you have it. There is not unlimited electricity from hydro supply in Quebec, and there are many, many demands on that power. Cathode plants are pretty energy intensive, just as many other of the industries that are being built there. There's more than just lithium and cathodes. There's graphite capabilities being built. So there isn't unlimited hydroelectric power. Today, at least, we could not just turn up to Quebec, build another plant, and tap straight into hydroelectric power. We're certainly talking to the province about availability low-cost hydroelectric power, but today at least it's not entirely clear there will be sufficient for everything that everybody would like to build there.
Got it. And just in the IRA in general, I mean, are you seeing it help steer automotive companies towards Western lithium producers and away from, I guess, some of your Chinese rivals? Is it working in terms of, creating non-Chinese supply chains, do you think?
I think the IRA is really a reflection of the desire to build more robust supply chains. We see it in semiconductor chips, and I don't think the IRA itself is driving that change. I think the IRA is part of the process and recognizes the general desirability of not having an entire industry go through one single geographic location. Right? It's not a comment on China, it's a comment on concentration in one place. And I think the IRA really is just part of the tools that the US government is using to help incentivize. But frankly, many of the OEMs themselves are also looking to diversify their supply chains.
And in terms of the cost difference you mentioned, is kind of extraordinary. Does that mean efforts to localize supply chains are doomed if we want to have a mass market EV, given those cost differences?
No, look, I don't think they're doomed. I think people sometimes forget what drives the economics and what drives, from an OEM. It isn't just lithium and the battery price. So the battery price will come down with manufacturing efficiency, but it's also just the general inefficiency, if you will, of EV infrastructure today. We don't have the battery plants have only been running a few years, so they're not running at maximum efficiency. We have yet to get sufficient lithium capability added to meet future demand. And as we do, that again will drive some efficiencies. Frankly, once the charging infrastructure is improved, then maybe we don't need quite so large batteries in many of these vehicles. So I still think there's a lot of technology change that's going to drive the cost of EV down. It's not just about how much you pay to build a lithium hydroxide plant or where you source the lithium. Look, I do believe that overall it's a different question, but it's just the reality of moving from an industry that 5 years ago was 200,000 tons of total demand, and 5 years from now will be 3 million tons of total demand. The cost of mining lithium doesn't go down in that environment, right? The next mines that come online, they're going to be higher cost, otherwise we would have developed them already. We will have mines reaching end of life, so we lose capacity from the industry over time. Many spodumene mines have 10, 15-year mine life and probably been running 5, 6, 7 in some cases already. So while there are exceptions, the brine resources, some of the very large spodumene resources in Australia, it isn't a simple path to lower cost lithium. But there are many, many other ways that the cost of an EV can be reduced.
Interesting. And in terms of geopolitics, I think you've made a fascinating point elsewhere about China's obviously feeling these efforts by the West to de-risk, etc. And in that sense, it makes sense for them to keep uneconomic lithium supply going within China, and especially supply that's controlled by the battery producers. How much does that distort the market? And does that mean prices are going to stay low for longer, right, if this supply is still hanging on?
It's not easy for them to continue to push that model. Right, there's almost like the low-hanging fruit of the first few lepidolite mines and a little bit of material, but you already see it coming out of Africa. But you see pushback on environmental grounds already happening in China, and you start to see pushback in Africa about exporting what is essentially a low-value added ore, and a push that no, they won't let it leave the country unless there's an increase in value added in country. And frankly, that's incredibly difficult, very remote, very poor infrastructure in many of these places. So I don't think that strategy is scalable at the same pace that the market itself is growing. And so I think it's another part of these classic disruptions that we've seen in the lithium industry. I go back a few years, and when everybody was chasing hydroxide and it was a 100,000 ton market, a new hydroxide plant was 20, 30,000 tons. It really disrupted the market. Today, a 20,000 ton plant doesn't disrupt the market. I think China's strategy here to build a base of, even if it's high cost, it's controlled, owned supply of lithium materials also is a short-term disruption and not replicable in the future. So I think what it will really do is, as you're seeing, I think it's holding prices down today. I would just comment, the last time prices hit a floor, they were probably half what they are today. And so it's a different floor for sure. And I think it's inevitable that and we're seeing already market demand starting to pick back up again, it's inevitable that the price will rebound again. I don't think we'll reach the crazy $70, $80 lithium prices that we saw a while ago, but it's not $15. It's not going to stay where it is.
And in terms of who is influencing the market, I think to your point you made before about battery cell inventories being built up, is it the battery producers that are really, in a way, controlling the lithium market now, not so much the cathode companies?
Yeah, look, if you go back a few years, it was certainly the cathode guy that was driving the purchasing decision. That's certainly not the case anymore. I think it's probably a balance between the OEMs and the batteries, probably more the battery makers today making those purchasing decisions, especially in China. I think Western OEMs have a very different philosophy and are looking to take a greater control of that supply chain, but not exclusively. I think the battery producer will always be a major buyer of lithium products because there will always be product in their portfolio that is not being sold to an OEM or is not being sold on the same contractual basis. So again, I think the diversity of customers, really, it's the battery makers and the OEMs primarily, but there's still a meaningful number of cathode producers buying material for their own use. There's a meaningful, non-battery applications or at least non-OEM applications, which are also pretty important too. So again, it's part of the evolution of this industry. It never sits still.
And how do you see the inventory situation now? Has that cell inventory been worked through? I mean, we hear a lot about overcapacity in China, low utilization rates at the factories. How do you see the current situation?
Look, I think what the current situation has probably shown some of those battery makers that the answer to a overcapacity, low utilization industry is not to ramp it up and produce as much as you can, because while you may drive your unit cost down, you just create false demand for the raw materials, and any gains in efficiency you lose in the fact that the raw material prices go higher. I don't see a lot of appetite for holding inventory in the market today. I don't see a lot of inventory, and I don't see a lot of appetite for holding inventory either. So I think today what we have is a market that is really waiting for signals as to what the next phase of demand is. And I don't just mean in quantum, but I also mean, we touched on at the beginning, is it LFP? Is it mid-nickel? Is it high nickel? Where do the OEMs want to go? And I think once they get themselves more clear to the supply chain, I think demand will rebound pretty quickly.
I mean, I guess we're talking in a week where Tesla's announced, cuts to its 10% cuts to its global staff. I mean, are you worried about, what we see as a slowdown in EV sales?
No. I mean, look, do I worry about it? I've always worried about it. I think if people used to ask me, what are people not looking at? I used to say, nobody seems to be challenging demand. You need to challenge demand. And I think now it's healthy that people are challenging demand. I don't particularly worry about any single automotive manufacturer. At Arcadium, we've gone out of our way to diversify our exposure. And it's one of the benefits is how the industry has grown. Arcadium was, as I'm sure you know, Livent particularly was very focused and dedicated to Tesla. Almost half of our volume at one point went to Tesla. That's much lower now. It's not even a fifth of our volume goes to any single customer today. And that's important to us. It's important to have that diversification. It's another benefit of the merger. It allows us to find the demand where it is. We have the different capabilities. And I think it's an important point. I think if you are just selling a commodity into a single product, you get a little bit more nervous about singular events. When you have a bit more diversification in the way that we do, it is much easier for us to find the demand where it is and make sure that we're producing the right material. I think in the long run, though, Henry, any reduction in excessive, irrational exuberance, if you will, with regard to demand can only help on the supply side. We're seeing that today. We're just seeing there is far, far less capital available for projects, and it can only help the supply-demand situation.
But we have seen, I guess, a 20% rally in Chinese lithium hydroxide prices this year. I mean, do you sense that we have passed the bottom and now we're going to see an upward momentum?
I think we found the bottom for sure. Have we rebounded off it? I've been doing this too long to predict the lithium price over the next few months. I'll tell you what it might be in the long run, but I can't really tell you what it's going to be in the short run. Look, I don't see any concerning signs around the pricing environment. That people are looking at, does pricing have further to fall? I don't see any indications that it's really going to go back down to historical lows. I think we have at least indicated a new low based on today's market. I couldn't tell you that I see a massive rebound coming soon, but pretty much every price rebound that I've seen in this industry, I haven't seen coming. So this one will be no different. I claim no crystal ball.
What's the strategy in terms of your increasing production by around 40% this year, lithium carbonate, lithium hydroxide? I mean, I guess you could say you're increasing production into a weak market. I mean, why continue to increase production when prices are this low?
The only way you increase production in our industry is to build more capacity. The only way you build more capacity is you spend 4 years doing it. right? And so if the price starts to fall last October, last September, I'm not suddenly going to stop construction. If I start the construction on a $600 million project, just waiting for the market to come back, whatever the delay is, you can then double because I've got to ramp back up again. And whatever the cost was, you can probably add a third to because it's incredibly cost inefficient to stop. The reality is that in these very long lead time projects, once you reach a certain point, you finish them. You really should finish them, right? Because it's incredibly inefficient, unless you don't have the capital to do so. Now, of course, what we're seeing today is ask me in 2 or 3 years' time when everybody will be screaming, where is the capacity? Where's the capacity? Decisions being making today will really hit us in 2 or 3 years' time. And the market is absolutely going to suffer from this collapse in price, probably in 2 or 3 years' time, maybe sooner.
And in terms of contracting, what have automakers learned from this cycle, right? Prices went crazy high and they obviously fell again. When it comes to contracting, putting in floors and ceilings, what are the sort of lessons they're taking?
Yeah, I think the first thing they've learned is the pricing risk for them is asymmetric. It can only fall so far, but it can go really high, right? And so I think the recognition that ceilings on prices are really valuable to them, and they don't mind paying for them with floors. Why? Because, look, I'll use some random numbers, but if a floor is $20 and the price is really only going to fall $6 or $7 below that, if the ceiling is $50, the price could go $20 or $30 higher than that. So again, it's an asymmetric bet, if you will. I think most of the market, us included, wants to just price with the market within reasonable ranges. And the floors and the ceilings are designed to reflect reasonable ranges. Any lower than the floor, we stop investing. Any higher than the ceiling, the economics for the OEM become challenging and we get potentially demand destruction. We're trying to find a way to work with the OEMs to create, a reasonable range within which the price can move. Nobody wants to build their OEM platform on the basis of they buy the cheapest lithium. That's not a strategy for any OEM I've come across. But equally, nobody wants to be punished because they're paying too much. So market-based pricing is somewhat inevitable, but we have to make sure that in a market with such pricing, opacity, we have to bring some discipline to it ourselves through our bilateral contracts with the customers. I think that's the biggest learning of the customers. They recognize it's asymmetric risk and it's in their interest to contract a significant proportion under these kinds of structures while the market matures.
Interesting. And what about the auctions that Pilbara Albemarle recently has done? What do you think about that in terms of a way of price discovery in this market?
Yeah, for spodumene concentrate, it makes a ton of sense. We're looking at it too. We don't have anywhere near as much volume, but in Mount Cattlin, we're looking at is there a better way for us to move material using these auctions? And again, look, I think the Chinese consumer of spodumene concentrate has created this, right? There's no desire amongst this Chinese market to put in place these sort of market discipline. The price is what it is for them, and that's fine. I completely understand that model. The natural conclusion to that is you sell to the highest bidder on any given day. You don't have customer relationships. You don't have contracts. That's certainly what I think is the right model for spodumene concentrate, for sure.
And in terms of hard rock, I mean, I guess that is one area that you've got Mount Cattlin, but it's coming towards the end of its life. At the current price environment, are you looking at acquiring more hard rock assets? We've obviously seen a lot of interest in Australian assets recently. Are you looking at that?
Look, it's hard to compete in Australia with some of the prices that are being paid. They require an assumption as to the future price, which is a long way away from what it's ever been. And it also, when you think about the economics as to how that compares to future carbonate or hydroxide prices, it's disconnected. So it's difficult if you want to be an integrated producer. It's not so difficult if you're a miner and you're willing to take a punt. I totally get that. It's not what we are. It's not what we do. We are looking at more hard rock resources, and we're looking in Australia. I don't have high hopes of buying anything in Australia. I think we're much more interested in other regions, particularly Canada, given we're starting to build a footprint there. We don't need it. I just want to be clear, though, to deliver the growth. I mean, we're talking about getting up to 250,000 tons a year of lithium production. That's with the existing asset base. So any assets that we add to that will probably most likely be for the next phase of development.
And just in terms of you are more diversified now, but you're still very reliant on Argentina. We have a new libertarian president who's called China, the enemy. How worried about are you about him and the direction he wants to take Argentina in, given China is such a huge investor there, and also most of your assets are there?
Yeah, no, look, I think it's a very different administration to one that I've ever seen before. It's much more investment friendly. It's looking to clear the obstacles to investment. I mean, there's a whole bunch of macroeconomic factors that will take time to resolve: currency, inflation, etc. The deficit they have. Even floating the currency is going to take them a little bit of time. But there are a lot of other frictional matters in Argentina that make it difficult to invest in. And my direct engagement with the administration suggests that they completely understand, in a way that no other administration has, what they need to do to clear the road for investments into Argentina. I think it is only positive in the medium to long run. Clearly, there are political concerns about whether the agenda can actually be delivered. It's absolutely a hugely positive agenda for those of us that are investing in Argentina, those of us that are exporting material out of Argentina. So I am extremely hopeful about this administration.
Interesting. And what about in terms of the US IRA qualifying for that? What have you heard about the status of that?
We don't pay a lot of attention to it. I'll come back to what I said before. If Argentina carbonate was IRA qualified, I would still have nowhere to sell it. There's still very few places to sell that carbonate, that the end product remains IRA qualified. So today, at least, it's not a particularly big concern. As I said to you before, we continue to focus on optimizing that network, which will, again, move most of the material into our hydroxide network today. We will be focused on, beyond that, where does the carbonate go? And as I said, I think we're not at the place yet that we see a big demand pool in IRA qualified locations for Argentinian carbonate.
Interesting. Okay, well, thank you, Paul. That's been fascinating talking to you, and thanks for your time. Yeah, great to chat again.
Thanks again. Appreciate the time as well, Henry. Thanks.